In the summer of 2026, one of the most closely watched investors on earth said something that made a lot of people stop scrolling. Ray Dalio, the founder of Bridgewater Associates, told Bloomberg Television that stocks were climbing toward the same danger zone the market hit right before two of the worst crashes in modern history. He put it plainly, saying the market was rising close to the same level seen in 2000 and the same level seen in 1929, based on his own bubble indicators that track sentiment, concentration, and valuation. That is not a casual comment. Those are two of the most feared years in financial history, and Dalio was putting today's market in the same sentence as both of them. This video is not a script written to scare you. It is a plain summary of what Dalio has actually said in his own public interviews, on his own social media, and in his own book over the first half of 2026. We are going to walk through his reasoning step by step in plain English so you can decide for yourself what to think about it. Along the way, we will explain the ideas he uses, like bubble indicators, debt cycles, and financial repression, in language anyone can follow. And at the end, we will look at what Dalio has said he personally does with his own money, based on his own public statements, not our guesses. Let's start with who is actually speaking here, because that matters. Ray Dalio built Bridgewater Associates into the largest hedge fund in the world. He spent decades studying what he calls the big cycle, the long repeating pattern of debt, money, and power that has shaped empires for 500 years. He wrote about it at length in his book, Principles for Dealing with the Changing World Order, and more recently in How Countries Go Broke, the Big Cycle. He is not a random commentator. He is someone who has spent his career trying to measure exactly the kind of moment he now says we are living through. So what is his actual warning? In January 2026, speaking at Davos during an interview with Bloomberg, Dalio said the rules-based global order that has governed trade and finance for decades was, in his words, already gone. That is a striking word to choose. Not weakening, not under pressure, gone. He was describing a shift where the old assumptions about how countries cooperate on trade, currency, and security no longer apply the way they used to. By June, his warning had sharpened into something more specific and more numerical. Speaking again to Bloomberg, Dalio said equity markets were rising close to, though not yet at, the same bubble level seen in 1929 and in 2000. He explained that this reading comes from his own proprietary indicators tools, built to measure things like how much of the market's value is concentrated in a small number of stocks, how euphoric investor sentiment has become, and how expensive stocks are relative to what the underlying companies actually earn. In a separate comment reported by Fortune, Dalio used a physical image to describe the effect of rising debt on the economy. He compared it to plaque building up in the circulatory system, slowly squeezing the flow of blood. Around the same time, Dalio also weighed in specifically on artificial intelligence, the sector that has driven much of the market's recent gains. In comments reported around his 2025 year-end review, he said the AI boom was, in his words, in the early stages of a bubble. He was careful to separate two different ideas that often get confused. Being right about the technology and making money on the stocks tied to that technology are not the same thing. He pointed back to the dot-com era as the clearest example. The internet did change the world exactly as its early believers predicted, but many of the stocks riding that wave collapsed anyway because their prices had run far ahead of their actual profits. Dalio's point is that the same gap between a real technology story and an overpriced stock story can happen again with AI. Now let's talk about the debt piece of his warning, because this is where Dalio spends most of his actual analysis. According to reporting from TheStreet, U.S. Treasury figures in early June 2026 showed total public debt near $39.2 trillion, with debt held by the public around $31.6 trillion. The Congressional Budget Office has projected the federal deficit reaching close to $19 trillion in fiscal year 2026, with government debt climbing toward 120% of GDP by 2036. Dalio's argument, as reported, is that this creates a self-feeding loop. More government borrowing pushes interest rates higher, higher rates make the existing debt more expensive to service, and that added expense forces even more borrowing. He has said that loop puts pressure on stocks too, because if investors can earn a strong, safer return from bonds, the extra risk of owning stocks becomes harder to justify. Dalio has drawn a specific historical distinction here that is worth sitting with. He has pointed out that in 1929 and again in 2008, the dangerous debt was mostly private sector debt, owed by households, banks, and businesses. Today, he argues, the dominant debt problem sits with the government itself. That matters because when a government owes the debt, its own central bank has a much more direct route to simply create money to cover it, a process economists call monetization. Dalio has drawn a parallel to the 1930s here, describing a pattern economists call financial repression, where a central bank holds interest rates artificially low through large asset purchases, sometimes alongside foreign exchange controls, to make government debt easier to manage at the expense of savers and bondholders. There is a geopolitical layer to this warning too, and Dalio has been explicit about it. He has said he recently spent roughly a month in Asia, including about 10 days in China, meeting with people involved in government and finance there. Based on those conversations, he told Bloomberg that Asian leaders he spoke with had concluded the United States could no longer credibly project military force across multiple regions of the world at the same time. He put it directly, "It's clear that the United States cannot fight a war," citing public unwillingness in America to absorb the casualties and costs that would require. He also said the long-running American strategy of trying to contain China's rise, in his words, that's over pretty much. On Taiwan specifically, Dalio has flagged it as the single most sensitive flashpoint in this story, arguing that China does not need a military conflict to shake the markets. According to Fortune's reporting, he said Beijing could rattle global markets simply by signaling a blockade on semiconductor exports, since so much of the modern economy, especially the AI build-out, depends on advanced chips. Dalio has also floated a term that has gotten attention on its own, a capital war. As reported by The Motley Fool, he used this phrase to describe a future where the free movement of money across borders, something markets have taken for granted for decades, breaks down because countries start treating capital flows as a tool of geopolitical pressure rather than pure economics. He pointed out that foreign buyers, including China and parts of Europe, have already been pulling back from purchases of U.S. government debt, partly out of concern about future sanctions or financial restrictions. Since the AI build-out alone is estimated to require something like $3 trillion in financing by 2030, much of it debt-financed, a slowdown in foreign appetite for USS. Debt would raise borrowing costs across the entire economy, technology sector included. Dalio has also pointed to a specific window of time he considers especially risky, the stretch between the 2026 midterm elections and the 2028 presidential election, when he expects debt pressures and political fights over taxes and spending to collide directly. It is worth pausing here to give this some historical grounding, because Dalio's whole framework rests on the idea that these patterns have happened before. Historians and economists point to several past episodes that rhyme with parts of his warning. In 1929, a decade of rising stock prices, fueled heavily by borrowed money, ended in a crash that wiped out enormous private wealth and helped trigger the Great Depression. In 1971, the United States ended the direct convertibility of the dollar into gold, a moment known as the Bretton Woods break, which fundamentally changed how the entire global financial system was anchored. In 2000, a surge of investment into internet companies with little or no profit ended in the dot-com crash. And in 2008, a buildup of private mortgage debt across the banking system triggered the global financial crisis. Dalio's own research, laid out across his books, treats these episodes not as isolated accidents, but as recurring stages of the same long debt cycle playing out again and again across different countries and centuries. So what does Dalio himself say he is actually doing about all this with his own money? This is the part where we have to be careful to stick only to what he has said publicly, not to guess. In a June 2026 post on social media promoting his book, How Countries Go Broke, Dalio wrote directly that he expects a similar debt and currency devaluation process to play out in multiple countries, not just the United States, naming Japan, the UK, and China as facing comparable pressures. Because of that, he wrote that he expects non-government issued forms of money, specifically gold and Bitcoin, to perform relatively well. He has also pointed out that gold was the best performing major asset class of 2025, which he has cited as evidence supporting his long-standing preference for holding assets outside the traditional dollar-based financial system. It is important to note what Dalio has not said too. He has not given a specific date for a crash. He has not guaranteed any particular return on gold, Bitcoin, or anything else. He has repeatedly framed his comments as risk management and probability, not prediction. As reported by The Motley Fool, even financial writers summarizing his warnings are careful to add that nobody actually knows whether or when a downturn will happen, and that Dalio's own framework is built around preparing for a range of outcomes rather than betting everything on one forecast. So where does that leave someone watching this and wondering what to make of it? Dalio's core argument, stripped down to its simplest form, is this: government debt is large and growing. Interest costs on that debt are rising. Markets are historically expensive by his own measures. Geopolitical tension between the United States and China is intensifying at the exact moment global capital flows are becoming more politically sensitive. None of those four things guarantees a crash on any particular date. But Dalio has spent decades arguing that when all four line up at once, the odds of a serious disruption go up, and that is the specific, sourced case he has been making in public through the first half of 2026. If you want to go straight to the source material, look up Ray Dalio's interviews with Bloomberg Television from January and June 2026, his social media posts from June 2026 discussing his book, and his book, How Countries Go Broke, The Big Cycle, where he lays out the full framework in far more detail than any single video can cover. Reading his actual words in full context is always going to be more reliable than any summary, including this one. If this kind of history meets markets breakdown was useful to you, let us know in the comments. On a scale of 1 to 10, how concerned are you about a debt-driven slowdown in the next few years? Just the number. And subscribe if you want more of these fact-checked breakdowns of what major investors are actually saying, sourced and cited, rather than guessed at.